Hello, hello, and welcome to Profiling Risk. This is your host Tony Cañas, switching to my radio voice, and today I have with me Terry Wang, co-founder and CEO at Cios. The Irish spelling Cios, pronounced Cios. We'll definitely want to hear why that is. Terry, first, thank you for joining me today. How's it going?
It is going fantastic, Tony. Thank you so much for having me. It is wonderful to be on this. Big fan of the show and really glad to share a story.
Awesome. Thank you so much. So it looks like you are in Toronto, Canada. Uh, where are you right now?
Oh, that's a long story. Well, we're recording this right before Thanksgiving,
Oh,
so I'm
true.
actually bouncing around all over the place. So I grew up in Toronto. I probably should be back there, although I am in Winnipeg right now. Long story about why I'm in Winnipeg, and we spend a good amount of time either in Fargo down in the States or in Chicago down in the States. And that movement is a big part of why we ended up doing what we're doing.
Okay. So Winnipeg or Toronto both fit exactly what I wanted to say, which is
hmm
that on November 20th, it's probably a winter wonderland by now.
It is actually raining outside. It is not that bad. It is a pretty good year. What's 10 degrees Celsius? Whatever it is, I'm already like over Canadianizing myself, so I'm gonna stop
Uh,
talking about the
uh,
weather on
uh,
that side. It is
10
plenty warm.
10 is about 45 degrees, so yeah,
Okay.
very decent. I luckily I speak both degrees fluently, because
Oh,
I grew up in Costa Rica.
okay.
I had to get used to Fahrenheit when I went to college and stayed in the States. But yeah, I speak, yeah, 10 is very, for Canada, 10 is very decent in the winter.
10 is very decent. It
Yes.
was like there was like we had full on blizzards a little while back. I think it was like mid October, and then there was a foot of snow on the ground. And now it's late November, and we're totally fine. So
that
it is
that
what it is.
is very weird. All right, so we always give the guest a chance to give the elevator pitch. What is Keys?
So that is a great question. So what we're essentially building is a new category of insurance meant to give residential multifamily renters more flexibility in their leases to move when they need to move while protecting cash flow for property owners and managers. I can get into why we're doing this, how we're doing this, but I really want to leave the questions out to you.
Okay, I'm a long time renter, and we
hmm
have moved around quite a bit. In fact, we kind of rarely finish a lease, and so we're kind of the perfect case study for what you guys are doing. So I've had leases as easy as you can break the lease by paying a couple of months to break it,
hmm
and I've had leases that are basically like you pay till the end. You're liable for the whole thing
hmm
when you break it. So I've had kind of a little bit of everything. So I would have loved a product like this. Uh, so you did kind of hint at how it came to be, where you guys kept moving around. Uh, how how does it work? So if I'm signing a lease tomorrow, how does it work?
Yeah, so that's a great question. That's a great question, and just to quickly touch up on that, like just like you moved around a ton. I think the exact number. Don't quote me on this. I might be wrong about my own self, but I think it's 8 or 9 times in the last 7 years. So decent amount. You can guess that I did not finish every single lease. There were a fair amount of subleases and relets and buyouts in there. So that's essentially how we realized the pain point was there. Like just people are looking for something different now that we're all renting. But in terms of how it works, the number one thing to realize is we sell almost exclusively to property owners. Nowadays, with insurance, more so than ever, I think it's really tough to buy insurance, to seek out to buy insurance, unless it's like a widely known mandated policy that we all know about, right? Auto works like that. And even then, I think if you sold auto at the point of purchase of a vehicle, you'd have like a 10x higher convert rate, right? So for us, we really want to partner with property owners, de-risk them, offer more value to their tenants, and really come up with a way to bridge the gap between these like really expensive short-term leases and longer leases for the folks that do want to stay as far as they know, but just have a lot of uncertainty in like a 6 to 12 month window. So we partner with property owners to embed this as embed coverage at the point of leasing. So you're able to purchase a policy at an enrolled property anywhere from the point of lease signing all the way through to 30 days post move in. For most people, that's anywhere from like a 45 to like a 90-day period where that purchase option is there. We'll remind you a couple times. We'll let you know when the last date for you to purchase is. You purchase a policy, you pay for it either monthly or all upfront, depends on what works best for you cash flow wise, and you're covered, right? As long as you're making payments on that side, as long as you fit our underwriting criteria, you're essentially covered for a wide variety of perils, right? And that's a real secret to how we're able to bring this policy out. We, instead of looking at this as kind of as an all perils coverage that's really, really prone to moral hazard and adverse selection, we're really focusing on specific named perils. We're looking at the like 7 to 8 out of like the 10 biggest reasons why people are typically breaking their leases early, whether it's for work, whether it's for their partner's work, whether it's for family, whether it's back to school, whether it's some small factor relating to those kind of 3 core groups. We find that covers about 70 to 80% of mainstream use cases. And what we do is that when you do need to move, something comes up in your life, we make it really easy for you to make a claim. We process it all online through our software. Once we validated it takes anywhere from a couple minutes to 24 hours if there's a little bit of complication. What we do is that we take over that lease. We help you set a move out date. We integrate directly in with your property manager software, so we get everything sorted out. You know when you can move out. We handle the remaining rent obligations, and you are on your way. Depending on your coverage, there might be a small deductible, but again, $250 is a small price to pay compared to 3 months of rent, right?
Okay, so sold through the property manager at the point of purchase. Okay, so the property manager is basically now, when I'm signing the lease, saying, hey, you're required to have renter's insurance. You can buy it through us if you want to. And hey, we offer this extra one that's not required. But that would
depends. It is sometimes required and it's sometimes not required, right? Okay. So that's one of the really interesting things when we look at the different segments. Like when we look at multifamily as like a broad asset class, most multifamily renters are staying in there for 2-3 years. They're fairly stable. Like they're living in there, particularly ones in Class B, Class C properties. It's not the biggest thing. But and in those properties, what we see is this type of policy is an opt-in or maybe an opt-out recommended product, right? Exactly like you said, sold through like the point of sold just like tenant insurance. Where we find a really, really interesting use case is on student housing. We call it young professional housing, and some of the downtown infill properties where there is a lot more transients, where there is a lot more movement. And some of these properties, owners are taking a big risk, right? Like vacancy is not fun for anybody to take, particularly if it's for like a student housing rental that might sit vacant for 8 months if a student leaves early, right? So in that case, we're actually finding a lot of traction, thousands and thousands of units now, where people are opting to mandate coverage across their buildings. Based on the risk factors that they're seeing, based on the risk of releasing that they're experiencing, just to make that process, just to protect themselves as well as protect renters from their own bad judgment.
Okay. So work relocation, a spouse or partner work relocation, family reasons are all covered. What kind of things are not covered?
So we've deliberately left that a little bit open-ended on that side. Typically, the way that we look at it is if it is something that is really, really prone to, if it is quite prone to fraud, or if it's quite prone to if it's impossible to validate, we can't really cover it. Right? Because ultimately, we want to prevent situations where people are just upping and leaving. There's a huge risk of adverse selection in there when people say, hey, I'm going to sign a 12-month lease because it's cheaper than signing a 6-month lease, but I'm going to leave in 6 months and I know regardless, right? That is something we just don't want. Ultimately, we de-risk that by requiring this across portfolios and getting a diverse enough risk pool. But for us, we also want to limit it by focusing on perils that people really care about. And you name some of the big ones: work-related relocations, even significant changes in work or significant changes in salary, up or down, we'll cover. But none of those things, all of those things are verifiable. All of those things are rare enough occurrences, and all of those things I think merit different levels of coverage, right? Versus it's very, very hard to coverage. It's very, very difficult to cover the feeling of needing to go, right?
Yeah. So basically, the things that you can prove that are external,
Exactly.
and that you can prove. Okay. Um, how do you underwrite this?
Yeah, that is a great question. Underwriting this is a pain it's a pain in the behind. It's not the most fun thing in the world, but it does make for a very, very fun challenge for our team. So the way we look at this is we really break this down into the individual perils. When you look at kind of flexibility as a broad scale kind of risk with vacancy, it's really, really daunting to take a look at underwriting wise. But when you look at it in terms of a specific peril, now it's a lot simpler. Now we're looking at, hey, what's the chance of academic dismissal for a student at Baylor University? I just came up with that off the top of my head. But that is something that is very, very easy to predict, right? So we've built out essentially a number of underwriting patterns based on these specific perils, and we look at what perils a specific policyholder is actually opening themselves up to, and we underwrite based off of that. We collect obviously a healthy amount of personal information, although that is much, much easier with the amount of software that we're able to leverage, the great API level tools we're able to use to bring in verified information. We're able to remove we're able to stay away from some of these long, like never ending forms. We're able to stay away from like having to trust people's like when like your auto insurer asks you like how safe is your driving, you're always going to say safe. Like we try to avoid situations like that. We try to be as empirical as possible. We bring in data sources from a variety of providers, both internally, both from our partners, as well as from broader third party aggregate sources. We bring that all in. We feed it into our underwriting algorithm, and we're able to produce out kind of like a risk assessment in very, very fast time, fairly accurately.
Well, did the data so with students that's a fairly easy one to figure out.
Yeah.
But for young professionals,
so
did the data exist?
So the way I look at it is the data always exists. It just might not be feasible for you to get all the data, right?
Okay.
So for us, we looked at it from a broad aggregate perspective first, right? Hey, how can we get a directional sense of how much risk we're taking? Well, like how often people are moving, and you dive into the different the different groups who actually categorize that, track that data. The U.S. Census Bureau does a fantastic job at providing broad scale information, even at the state level and the county level. A lot of interesting trend movers there. And one of the really interesting things that happen is if you track it by NAIC codes in terms of the different job titles people hold, in terms of different seniority levels, you are able to track work movement very, very tightly. The other area where you're able to track this quite a bit is anybody that's registered for services like I just went through this process, so I do know. But if you're going through TSA pre-check, like they actually do a fairly rigid screening of like your past 3 years of moving history, is your past 3 years of employment movement history, and you're able to cross-reference those things and see when people have been relocating for work. Right. So it's really looking at a variety of weird data sources that you wouldn't necessarily think about, and really, really we really rely on having like just an insanely creative and insanely great team in terms of figuring out these specific risk factors, understanding how to build out those algorithms, and understanding how to predict risk in a statistically valid and relevant way.
Okay. And given that it's a young company, I'm assuming for now it's an MGA.
Yes. So we're operating as an MGA right now, although we are taking a strong look at the full stack path. I think it's something I was actually in a conversation earlier, but I think it's something that is increasingly more relevant in today's like market conditions. Reinsurers have heard time and time again, this MGA has a great idea, and this MGA has a great idea, right? But where is the proof, right? Like how much premium can you actually write? Are you willing to take risk on your own balance sheet or on a captive balance sheet, right? Like what are you willing to do in terms of like what is your own confidence in it? So one of the things we've been looking at as we continue to grow fairly rapidly and are able to secure more and more distribution is into a sell captive or a captive, and really look at different ways to bring this on board. Of course, I think the traditional MGA model is also fantastic if you can find the right partners and if you can find the right opportunities, not just from a capacity standpoint, but also from a strategic perspective as well.
What are the premiums like? So like the average renter's insurance is probably $15 to $25 a month. What does it look like for this coverage?
Yeah, so we actually use that as a benchmark for us. We know that renters, the vast majority of renters in multifamily properties across the U.S., they already have that frame of reference. They know that typically a renter's policy is going to cost them anywhere from $15 to $25, and it'll cover some of their personal belongings, some liability. It's super useful if there's a fire or a flood, but like largely like that's a cost that like just disappears. They know what utilities cost, and they know that rent is growing up fairly fast, right? So what we know is we want to be in that vicinity. You don't want a product that costs $150 a month. That is, I think you're just going to get like abysmal conversion rates, right? At the same time, we know that people are willing to pay a premium for this. We've done the research on this. 60% of the tenants that we talked to out of a significant sample size, 60% of them were willing to pay at least $100 a month for a policy like this. So we know that there is some pricing flexibility. We ultimately decided to base it on a percentage of rent. Up to a point with minimums and maximums. Typical premiums are between 3 to 5%, and we offer significant discounts if a policy is mandated or around a property, where we're looking at about half of that.
Okay. What's the TAM? What's the total bar? Like, because I remember
the TAM is both tiny and it is humongous.
That's what I'm saying. Like yeah, there's a lot of apartments.
Yes,
but compared to other lines of insurance, it's a small line.
100%. And I think that is what really, really excites us for us. There's some really exciting future paths and future applications for this new category of underwriting and of risk transfer that I think are going to be extremely relevant in the upcoming decade. But we don't really have anything fleshed out there, and we're still very early in ideation phase for those future developments, so I won't get into it too much. But just off of this core residential market, the way we look at it is as very early movers and as true category creators, we essentially have the ability to set what this market is, right? If the demand is there, like we anticipate it will be there, if we're fulfilling a need that has not been met, I think there's tens of billions of dollars a year worth of premium to be written. And I think from a realistic perspective, you're looking at like maybe 10% of that, right? I think as a realistic target to be going at. And I think at a pessimistic level, I think you're looking at a fairly small market, fairly restrained, maybe in the hundreds of millions to low billions in terms of annual gross written premium. It all depends on how we're able to do in terms of bringing this to market. If we're right about some of the core assumptions that we've made as a startup, if the lifestyle changes that we've seen happen over the next 10 years will continue to develop, which I certainly think they will. Just us having this call, I think it makes me more confident that things like this will happen. Hearing that folks like you have went through the exact same things from a moving perspective gives me confidence that this is something that is happening, right? Talking to students, talking to 25, 26-year-olds today, that gives me confidence that, hey, there is really a sea change that is different from the way people acted 30 years ago. And the industries of tomorrow will be fundamentally different from the industries of today, right? So we're very, very bullish on this, although I will say, like, it is not like we're not talking about like the biggest TAM in the world when it comes to insurance markets, but it is definitely not no small fish.
Okay, so according to LinkedIn, it's been about a year and a half, almost 2 years since you were running the company. Where in the process are you? How many apartment complexes are you deployed with? Kind of what's the reality today?
100%. So we've got 9,100 apartment units
Okay.
enrolled at this point, and the biggest challenge for us is how do we make sure we have the ability and the capacity and the resources to support everyone, right? So from our perspective, whether it is fundraising and whether it is making sure we have the best possible operational team available, whether it's shoring up our capital reserves and making sure we have the capacity, the internal capacity to deliver, partnering with great carriers and reinsurers to be able to deliver this product out to a broader market. I think there's so much growth coming in the next 2-3 years. We just want to make sure that we're diversifying our risk pools. We're building a fundamentally profitable product, and we are making sure that we're continually shooting for excellence there.
Okay, so at this point, you've got maybe 1 year worth of loss ratio development.
No, not even one
Not
year
even.
in. So we are very, very early in terms of looking at loss ratios. So I won't comment too much. Knock on wood on everything I say on that side. But please do reach out if it's something that is interesting. Like I'd love to chat more about that. It's just that the numbers there are so early that I think we're talking fairly speculative.
Okay, so at this point, you're looking for VCs. You're looking for angels that do a lot of insurance. You're looking for carrier internal VC teams. What kind of investors are you looking for?
Yeah, so that's a great question. So from an investor standpoint, we're really lucky to be playing in the middle of two very, very capital heavy industries, right? We know how much money insurance companies have, like it's no secret, and it's the same is true on the other side of a lot of these real estate firms. In fact, there's actually a lot of there's actually a lot of overlap between the two. There's a lot of reinsurers with very, very significant real estate exposure. And likewise, there's real estate companies whose single biggest line item outside of their mortgages is insurance. Right. So there's a lot of understanding on both sides there. There's a lot of interest on both. We're essentially looking for really strategic investors who can bring a ton of value either from the insurtech perspective or the prop tech perspective. And I think they're actually much more similar than people give them credit for. Right. We've had some fantastic conversations already with folks on the carrier side, as well as folks who are more traditional VCs, but who have a lot of exposure into insurtech. And we're really excited to continue building these partnerships as we scale this up.
Okay, very, very interesting stuff. It's awesome to hear of a brand new product, and especially sometimes we have guests talking about a brand new product, and I'm like, is there really a need for this? This particular one is one where I can see the need. It's more about how do we package this into an actually
exactly
profitable insurance product.
And that's the secret sauce, right? I think ultimately where we want to be is, hey, this is a need that I think we can start to see. We're definitely early on this, right? We talked to some older folks, some more conservative folks in the industry, and they definitely don't see it, right? Which really excites me, because if everybody sees the need and the product doesn't exist, you're probably dead in the water already. But if you're early, if that opportunity is actually there and you're riding that wave of change, then you just need to make sure you can execute, right? And that's where you really rely on having great talent. That's where you really rely on having great partners. That's where you really rely on having really, really good feedback from your partners and your customers, right? And for us, it's really balancing those things together, and that's how we want to lead the company.
Excellent. Great chatting with you today. Thank you for your time. When this goes live, I will tag you on LinkedIn, and I'm assuming that's the best way to connect with you for anybody who's interested.
Yeah, LinkedIn is a fantastic way of getting in touch with me. Happy to chat with you there. If you want to go to our website, you'll have to learn how to spell the name of the company, which we can get into a whole nother conversation about why we decided.
Yes, I am very curious. Why spell it CIOS?
Okay, so we originally were going to name the company something else. We had jumped over a bunch of different names. All of them felt cliche, right? Like you take two nouns, you put them together, that's a company name. Or you take one noun and you trademark it somehow and you make that a name. We looked at a bunch of those things. But we weren't really happy with them. One of my co-founders, they travel quite a bit. So we're like, hey, why not pick a foreign word? Why not pick a foreign word? And we're like, hey, like you had just done like a layover in Dublin before. What if we used Irish? I've never heard of a company using Irish before. So we jumped in. We're like, what is an Irish word that means to rent or to, and we're like, oh, keys. Oh, that's great. Like you got the meaning there. It means to rent. You've got like the symbolism of it being like a key, like a physical little key, the way it's pronounced. And we're like, hey, this is genius. We're the greatest. Like we're great entrepreneurs. We're great founders. We know exactly what we're doing. We went, trademarked the name, got it incorporated, and then the morning afterwards, we wake up and we're like, oh shoot, this name was non-phonetic. Nobody's going to know how to pronounce this. We're like, darn, we have quite the education task in front of us. But in either case, we are very, very excited. We're very, very excited despite our name. We think this is going to be a great product. If you want to reach out to me, you can find me on LinkedIn, or you can go to our site at www.get, that's GETCIOS.com.
Excellent. Thank you.
Thank you very much, Tony.